Okay, we're live streaming. A lot of folks I'm not here yet, but I'd like to start on time. Get out in the world of work and then be on time, right? Same way with the class, gotta be on time. I know these engineer folks, look how far they have come over to the class. So you say you jogged over or you drove over?
Parked.
Or it's being building? Leave there all day and just walk between. Okay. This is the first class for someone. I stressed attendance one year. I had that was an 8:30 class, and this young lady at that time was a 4-lane, 2-lane. She tried to get to class on time, and it hit on accident. I don't want you to get try to get here safe on time. Okay. But I know you do get held up sometimes with construction, whatever else is going on. Okay, let's see who's here. Amber, Cole, Robert, Mr. John, Robert.
Yes, sir.
Alexandra,
Here.
Say,
Here.
Matthew. Matthew's never been here. Here. Alexandra, Fanny, Justin, Margot, Harper. Harper here again. Robert, Robert Harris. Okay. Brian. Dylan. This young lady has never been in class. I've caught her on the computer. Her name is Manlaka Krnjaja. Thought of a computer, and she'll probably be here Tuesday. I talked to some of her international friends at night, and she won't be coming to this country. She'll get into this country on Sunday. So hopefully she'll get twice on Tuesday. We'll be behind 2 weeks, but she'll get caught up. Coda, Kelly, Johnny. Hey, Johnny, that's perfect timing, isn't it?
Yeah.
It's called JIT, and accounting JIT is just in time. Just in time applies to inventory. So you only keep it 3 days supply. Okay, Jeff? Sam's? Kinley, William? Jacob? Joshua? Corey? Justin Jones? All right. Okay, a lot of you have logged into Cengage. You haven't done any work yet, but at least you've logged in, so please do that as soon as possible. I'll have a roster on there for 2 places, day and night classes. So I think about 20 out of about 35 have got into Cengage. Do that as soon as possible. It's a big part of the class. Now, how many of you have finished chapter 1 on Cengage? Okay, 2 or 3 of you, and 2 or 3 of you have worked at it, want to go back and improve their grade, so forth. So, but anyway, wrapping up chapter 1 this morning, one thing we did the other day was a problem using the accounting equation. And then from that accounting equation, we did a income statement. I asked you to finish those statements before today, and I'm sure most of you have. The solution, they got it all mixed up here. But anyway, the bottom line for this problem was an income statement, an equity statement, and a balance sheet. Now, you'll have those on Cengage when you go in there to work chapter 1, and you'll have these in chapter 2, and you'll have them in other chapters. So you'll learn these 3 statements. I don't even ask you for a definition of a balance sheet because you'll know what it is after we do enough of it. And you should know what an income statement is even after you do one. It shows net income. All right, if you're looking at your statement, you should have it in front of you by now. And you should have a 3-part heading and make sure it's for month ending. An income statement is for 1 month in time or one period of time. It could be for 3 months or a year, but most corporations do monthly income statement and list your expenses. Now be careful and put your dollar mark in front of a column and in front of a sum or difference. What is this difference here? Was that 1340? 1340. All right, I don't know why the solution has cut it off. Okay, so an income statement. Easy to do. Revenue and expenses. You have one on a test coming up, in a week or 2, you should be able to do a little income statement. All right, and the equity statement. Your beginning equity, you could have put that here, it would have been okay, but the owner invested $4,000. We made $1,340 net income, so you got to do the income statement first. And then we took out $500 for personal use. So our income is $4,840. All right. You could have had 4,000 here. You could have had 840 here. Would have been okay as long as you get 4,840. That is your ending capital. And your ending capital has increased from 4,000 to 4,840. Now, if this were an annual income statement and you had to do your own taxes, you pay taxes on the 1,340, your net income in a proprietorship. You do not pay taxes on your withdrawals. You pay taxes on what you earn. And then to continue on with it, that balance sheet don't look too good. Solution is printed over it. Anyway, what is your total assets? Is that 5,080? Okay, 90. 5,090 is your total assets. You didn't have many assets. What'd you have? Cash, supplies, and accounts receivable. That was it. All right. Okay, and then you had one liability, is that 250? And you had the one capital account, which is 4,840, and those two add up to be 5,080. That's the kind of equation. So you got to do the capital statement second to get the ending capital balance of 4,840. So in order, an income statement, an equity statement, and then a capital statement. Okay. All right, that wraps up chapter 1. Okay. Do you have any questions on this accounting equation? Get into Cengage and get your book. Now, if you haven't gotten the book yet, you're going to get behind. Hate to leave you behind, but you're going to get a book. We will leave you behind. We have to. Remind you, there's still a book up in the library to check out and use up there. Okay. A couple of my nice students, international students, somebody gave them a textbook. All right, but when they went on the Cengage, each one of them had to pay $100. Get a key for Cengage. Well, that's still just $200. So they're both now on Cengage and are using the same book, so they save $200. Okay, but there's no book floating around anywhere, it is. And you just have to pay 100 for Cengage. Okay. All right, we're going to start chapter 2. Now, how many of you said you had accounting or bookkeeping in high school? Okay, chapter 2, some of it might be a repeat, but we will soon cover. Let me find my PowerPoint here real quick. But we'll soon, in a few weeks, pretty much cover what you've done in high school. All right, now here's what we did in chapter 1. We did the accounting equation. And we know we can take this accounting equation and we can take these figures here from 7,500 fees earned, subtract expenses, and get net income. We know we can do an income statement. We know we can take beginning capital, add net income to it, and subtract drawing. I'm assuming 2,000 might be drawing, and what it is, and get a capital statement. And here you have cash, supplies, and land, assets on a balance sheet, liabilities, and ending capital on a balance sheet. So you can do all your statements from this one, as we did the other day. All right. Do this, do it on Cengage, and then forget about it. Because we won't be doing this anymore in any accounting class. This is it. Chapter 1 is it on the accounting equation. All right, we're going to start using, I hope my pen works this morning. We're going to start using T's. They're just used for teaching. They're not real world accounting. We've got a left side, we've got a right side. And we'll call this the debit side, and we'll call this the credit side. All right? Now, a title could be cash. So we'll have a T account and some problems for every account we have: cash, supplies, land, drawing, capital, fees earned, and so on. All right, cash will debit increases cash, and a credit will decrease cash. But in a ledger like this, you've got to add up the left side and add up the right side and take the difference, and that's called footing. All right, but these we just use once in a while, T accounts. Now, all of these accounts together make up a ledger. And all of the accounts together make up a chart of accounts that make up the ledger. So a chart of accounts makes up the ledger. Certain assets, now we know the resources that we own or you owe for. Like I said, if you have an automobile, and if you owe for it, you and the creditor own it. Liabilities usually has a payable after them, but not always. There's a couple of cases whereas liability does not have payable attached to it. Then there's owner's equity, and then there's drawing. Owner's equity, of course, is your capital investment. Revenues can take different names: fees earned, commission, rent. There'll be other names, sales, and so forth, that are revenue account. Interest revenue, dividend revenue. Expenses, there's many that we could add to this: tax expense, salary expense, many, supplies expense, insurance expense. So that brought us up to a chart of accounts. Now, asset starts with 1. Liabilities 2. Equity 3. And 4 for revenue and 5 for expenses. All right. This company can only have how many assets if they start with a 1? 11, 12, 13, 14, 15, 16, 17, 18, 19. They could only have 9 or so assets. A bigger company might want to start with 111. Then your liability starts with 211. So before you get to 200, that gives you 89 assets. Someone like General Motors may start with 1,000. All right. And when they get up to 2,000, they could have 999 assets. So 1 starts an asset. 2 starts a liability. 3, equity. Now, you learned what double entry accounting was, hopefully. That's we record everything in 2 places. When you did that owner's equity statement, it affected 2 things. Everything in accounting, every transaction affects 2 items. That's why we call it double entry. And in a balance sheet, you still have assets, liabilities, and equity. I'll look at these pluses and minuses in a minute. Income statement items, drawing. So let me give you the accounts. We have an asset, a liability, capital, withdrawals or drawing. We have revenue, and we have expenses. Now, what will increase an asset? You will need this when you make journal entries. So please jot this down. It's in your book in a different form. Some of you may understand this form better. A debit will increase an asset. A credit will increase a liability. A credit will increase capital. A debit will increase drawing. A credit will increase revenue. And expenses will be a debit. All right, everything in accounting has a reverse. If an asset's a debit, a liability definitely is a credit. If a revenue is a credit, an expense is a debit. Now we have 3 credits here, and we have 3 debits. All right, now if everything has a reverse, what will decrease an asset? Sure, a credit. What will decrease a liability? And increase capital or decrease capital? And decrease drawing and revenue and expense. Everything has a reverse. Now, if this were cash as one of your assets, a debit will increase your cash and a credit will decrease it. What kind of balance do you want? What kind of balance do you want in cash? A debit or a credit balance? You want a debit balance. So we'll look at normal balance. I'll just put NB there. The normal balance is the same as what it takes to increase them. The normal balance of cash or an asset is a debit. Normal balance of liability, a credit. Normal balance of capital, a credit. Normal balance of a drawing is debit. Revenue is a credit. And expense is a debit. So these are totally reversed. So in accounting, learn half the stuff. The other half is reversed. So you only have to learn half of accounting, okay? Reverse it and get the whole. All right, and in your book, you should have rules of debit and credit, normal balances. They're illustrated here in the green. The same thing I just gave you. Now, fees earned usually only have a credit entry. Supplies have both. This normally is credit, normal debit, normal both, normal credit, well, both. As you pay your liabilities, drawing is normally just a debit. So don't worry about that at this point in time. All right. Now we're going to look at a journal. Right, that's a general journal. This is the very first step out of 10 steps in the accounting cycle to make a journal entry. Every transaction has two. Every transaction has a debit and a credit. You can't have two debits, you can't have two credits. You gotta have a debit and a credit. All right. Now, what I want you to do is look at this journal entry. See this journal entry right here? All right, you got a sheet of journal paper. All I want you to do is copy that journal entry down on this journal paper. Copy it down. Okay, if you got that copy down yet, make sure you put the year, the date, the debit to credit, the explanation. Make sure these are on two different lines, one for the debit, one for the credit. You got that written down yet?
Yes, sir.
All right. That's good. Almost good. I'll tell you what's wrong with it in a minute. Did you jot it down? No, not good. Yours is not good either. Find out what's wrong with it. That's okay.
Oh, yeah. Push this into-
There's just a little something wrong. But So we mess it up.
Yeah.
Okay, copy. Right. All right. Some of you can't copy, so you better not try to cheat on a test. You'll copy the wrong answer. And seriously, one time I had a student that copied the other person's name. I am serious. They were cheating and copied the other person's name. Now that's fake. All right. And one time I had a class, was in an auditorium and had about 50 students in a survey of economics class. And now this is a dead giveaway that somebody cheated. I gave multiple choice on that test, and I gave a couple little short essays. And female here in front of some guy in the back, the female wrote a question. Mr. Lester, I don't have any idea what you want to answer for this question. And the guy that was cheating from her in the back of her, you know what he put on his test? I don't either. So, if you ever cheat, be good at it. Anyway, for you people this morning that can't copy, of course, the year here, November, and then November the 1st. Now, if you use other days of November, 2nd to 5th to 10th, you don't have to put November down again. You don't have to put the month down till you change into December. Now, the debit is to the left of the margin. All right, the credit is indented. 2 or 3 of you did not indent. And a couple of you put 25,000 on the same line. You can't do that. A debit and a credit, 2 different lines. And then here's an explanation, invested cash and net solution. So you got 3 lines there. Some of you put all that on 2 lines. So this is an explanation. We won't use that much. You don't have to do it on a test. Whatever Cengage wants you to do what Cengage wants you to do, but we don't have to go around. Now, computers makes you work harder or smarter, not harder, right? Now, if you can do the first step of the accounting cycle, computers will do the other 9 steps for you. They'll take this journal entry that you make during the month, and any day of the month, you can print out a balance sheet, an income statement, an equity statement. So the first step of the accounting cycle is all you need to know if you're going to put it on a computer or a program like QuickBooks Pro or Peachtree or some accounting program. All right. But we learn everything manual. All right, common transaction terminology, receive cash from services, we debit cash and we credit fees earned. We know when you did the accounting equation, you had to put a plus under cash and you had to put a plus under fees earned. Well, a debit is a plus to cash and a credit is a plus to fees earned. All right, the second step of the accounting cycle is taking these items and putting them in a ledger. Credit cash to reduce it and debit land to purchase it. But still, that's a T account. All right, here we debit supplies and we credit accounts payable. A debit supplies increases supplies. A credit to accounts payable increases accounts payable. A debit to cash, increase. A credit to fees earned, increase. All right, on November 30th, net solution incurred the following. Now, this is called a compound entry. Anytime you have more than one debit or more than one credit, it's a compound entry. There was no need to make 4 different entries here by debit and each expense and credit and cash. We made 1 entry, not 4 entries. But yet they are posted to their T accounts, ledger accounts. All right, debit and accounts payable and credit cash. Now that decreases accounts payable and that decreases cash. And here we debit supplies, expense, and credit supplies, like we had to figure out in that little problem you had. We bought supplies and we used 180 and we had 170 left. This will take care of your increases, decreases. Drawing is debit, credit, cash. And that's called posting. That is the second step of your accounting cycle. Journal entry first, post second. Now, here is a better looking ledger, not a T account. If we wanted to say it's a T account, then it's a T account, just like that or something. Okay? But it's not a T account. It's a ledger, does the same thing as a T account does. But here we have a debit and a credit column. And this is your journal entry. Now here is your ledger. It's a 4-column ledger, as you can see. At any point in time, here we're prepaying insurance. It has a debit balance. Cash, debit, has a debit balance. And along the way, we paid out cash, we received cash, we have a $3,500 balance. Just like your checkbook, you can look at it any day and should and look and see what your balance is if you keep your checkbook up to date, that is. So this is the ledger more or less we'll be working with. All right, now posting. They don't have a good illustration here, but if you've got prepaid rent of $800, all right, you want to put that, a rent expense, you want to put that in the rent expense account. Now you'll bring this 53, the number. Remember, expenses starts with a 5. You'll bring it up here and put it in that PR column to show that you posted. Now posted, I'm not worried about it too much. I won't even give it to you on a test, but you will have it on Cengage and a problem. You need to know what it is, but nowadays, a computer program posts is for you automatic if you can do that journal entry. All right, it says here, unearned rent is a liability. Don't have payable after it. So the landlord takes $360 in advance. That might be for 3 months, 120 a month. It's unearned to him until you stay in that building, okay, and then he earns it. Then we have to take it out, okay? But the landlord does have the cash. He has to debit cash. But if you don't stay there, he owes it back to you, depending on what the lease agreement says. So unearned. Okay, buying office equipment and credit accounts payable. Paying miscellaneous expense, debit expense, credit cash. Paying on accounts payable, debit accounts payable, credit cash. Paying wage expense, credit cash. Debit cash and credit fees earned. We're really working with the same thing that we did in chapter 1, but we're putting in journal entries. We're not putting pluses and minuses to that accounting equation. We're putting in journal entry form. Then we're putting it in a ledger. All right. So we know that we're on the accrual basis of accounting. Now, a one-man operation might use cash basis. If his cash basis, he don't worry about accounts receivable and accounts payable. But on the accrual basis, when we make money and we earn money, we record that money as fees earned or revenue, but somebody owes it to us. We debit accounts receivable. Accounts payable, again, accrual basis of accounting, debit to payable to reduce it and credit cash. All right, debit cash, credit accounts receivable when they pay you. Now, a lot of you, when your accounts receivable is paying you, you want to debit cash and put it in sales revenue or fees earned again. Don't do that. When you debit accounts receivable and credit fees earned, you've got it recorded once. Don't record it twice. Debit supplies, credit cash. Debit wage expense, credit cash. Debit utility expense, credit cash. Debit cash and credit fees earned for cash services. Then debit accounts receivable and credit fees earned for account, services on account. All right, debit drawing, credit cash. All right, now if we were looking at the cash account, its number is 11. All right, and we started off with 25,000 balance. Now, we should never have a credit balance over here. If you do, you're writing out bad checks, aren't you? So don't have a credit balance in cash or any other asset, hopefully. But we can look at any day and time. What is your cash balance on the 31st? The second 31st, what's your cash balance? All right, what's your cash balance on the 16th of December? All right, at any point in time, you can see your balance. And that's what a good 4-column ledger does. Again, a ledger is a T account. All right, now when you go over here and post to cash, all right, if we post it over here to cash, we bring over the 11. Well, no, that's accounts receivable and that's supplies. I have to show you that in a minute. Now, where did this come from? This came from journal page 1 or page 2 or page 3 or page 4. So that post and reference is just a page number of the journal in case you want to backtrack and find something. Okay, general ledger, bunch of ledger accounts, more ledger accounts. But now, the third step of the accounting cycle is to do a trial balance. Now, a trial balance proves debits and credits are equal. Debits equals credits. That's what it's doing. For every debit, you put down a credit. But now some of you transpose. In your checkbook, if you put down $91, but it should have been, let's say you wrote out a $91 check and you subtracted $19 from your checkbook. It's going to show you got too much in it and you're going to be overdrawn. But most transposed numbers, the difference is 72. And if it's transposed, most of the time it can be divided by 9 and it will come out even. All right? But 7 nines are 72. Okay? So that's transposing, and many of us transpose. Okay? You don't see numbers the way you should see them. Now, how much is this? How much is that? All right, it looks like 1,000. But when I recorded, I forgot to put in my decimal. That's a $990 mistake, isn't it? Now that's called slide error. So get your decimal in the correct place. Most of the time in these columns, you've got your cents column separate. So slide errors, transposing errors, and they're showing you some transposing errors here. All right, now we had a debit of 5,600 was journalized and posted as a debit to salary expense and a credit of cash. Well, that's a big mistake, isn't it? How do you straighten it out? All right. It is not correct anywhere. All right, you got a credit salary expense of 65 to get rid of that. And I would give debit cash of 65. I'd just reverse that. Then I'd make the correct entry. A fee of $28.50 also is posted wrong. A payment of $3,500 to a creditor was posted as a debit to accounts payable. That seems to be correct. And a debit to cash. No, cash should have been what? So now it's going to show that you have $7,000 too much in cash. You got to correct that. All right, so we will look at making corrections.
So we have to actually subtract it back here.
After what now?
We have to show on there that we subtracted it. If we did it wrong, we have to do the opposite.
Yeah, just put a corrected entry. Yeah, corrected entry. Here they mention horizontal analysis. We won't work with that too much. Horizontal is which way? Left to right. Now here, from year 1 to year 2, you had an increase or decrease. So you divide the 37.5, the increase or decrease by the base year, which is 1, divide that by 150, and you'll get an increase or decrease of 25%. We won't work much with horizontal analysis. But these are income statements. Okay, now I want you to turn to the end of chapter 2 in your textbook. Turn over to the problems and exercises in chapter 2 of your textbook. All right. I want you to turn to page 92, exercise 7. 92, exercise 7. Now, some of you learn by reading, some of you learn by watching. I put up on PowerPoint. But by golly, most of you learn by doing. Okay? So we're going to do it, okay? We're going to make journal entries for this exercise. And the first one is paid rent. You got a sheet of journal paper, just go on down. All right? Use that journal paper. And you need to see a textbook. Good idea. Then you're switching over here. All right? Find somebody that has a textbook. Let's check here. Go. Yep. There. All right. Okay. That's part of it. Okay. All right. One more thing. Okay, that's first one. Let me help you with it. Pay rent. All right, now I want you to skip a line between entries. All right, do we have a date here or is this just, all right, put October 1. Skip a line, put October 1, leave the same year, it don't matter. Now, on the first line, what are you gonna put? If we paid rent, we want to, decrease cash and we want to increase rent. So we debit rent expense. So first line, debit rent expense for that amount. How much is it? 3,600. Now, how you gonna pay that rent with what?
Cash.
So credit cash. And you made a journal entry and some kind of explanation, just put pay rent. That's third line, pay rent. All right. Now go on and find this more journal entry. And I'll walk around and help you check if you're doing it right or wrong. Okay? Okay, now this first one here, I want you to put rent expense. I don't know what you have. Okay, yeah. Put rent expense, 2 words, rent expense, and put them out here. I want you to then put cash here, put it over here. I'll be back and check. No, you're doing that right there. Expense, cash. Rent expense, cash, pay rent. All right, put your dollars over there. Okay, you got it. All right, let me see if you got that second. You put rent expense and cash. All right. Pay rent. Now skip a line. Skip a line. Oh, I see. All right, rent expense, cash, pay rent, skip a line, pay them, good, so on. That's your part over here. Rent, credit, cash, pay rent.
There's a skip line like that. Yeah.
Oh, yeah, we got it. Skip up. Skip up. Between each transaction. All right. Got it? Oh, come on. Erase. Oh, with the same amount of free. Intent that cash. That's right. Pay rent. Right, well, did you? Line straight. Pay rent $1,200. Did you pay rent $1,200? Did you go down and goes up? No, I'm not saying about that. Say that. Was that ever?
Oh, yeah.
No. And get rid of that. Now, some of you are good at writing down what I said when I said credit cash. You wrote down credit cash. No, I want you to write down just the word cash. And it did it, because it is a credit. You go put the dollar amount on the credit. I can see where you got that from. I said credit cash. All right, skip a line. Okay. That's all. That's all.
There's just a lot.
Line, credit. What is it? Cash.
Oh.
But it does not.
Credit.
Stay there.
Got supplies. I guess you really have cash. I think they update to the credit bill sale.
That's correct. Now you purchase your homes.
Oh, yeah. They pay cash.
We credit cash.
We receive cash from a customer of the town, so that goes on our fee. Yeah, there's our fees by ourselves.
Oh.
That's what it's all.
Purchase office equipment on campus.
John, you get straight? One account means accounts payable. When we receive a cash, it means accounts receivable. But it's all equipment on account, debit equipment, means you credit, accounts payable. All right.
All right.
What's that shoot?
13 actually.
Thursday.
But, okay, for 15 it says, paid credited on account $7,502, right? So my account's paid.
Payable debit.
Debit. Okay, that's fine.
Real good, okay. Now, right here, these look good up here. But this you reverse.
I should have had it at the top.
Yeah, the equipment is your debit
Okay, I got you.
and credit your accounts payable. Now,
Okay.
you did debit your equipment, but you always look good for debit.
Debit's first. Yeah. Okay, awesome. That's good.
Okay, now let's see. What we got up here. All right, rent expense debit, credit cash, advertising expense debit, credit cash. Now, indent, you put the credit indent in. All right. Supplies, now that's just supplies, it wasn't expense yet. And this would be, take off the word expense, and here put office equipment and credit accounts paid. Okay? So straighten them out, don't forget.
On this one. As a receive cash from customer account, you debit your fees earned and credit your account. Oh,
Okay. You receive cash, so what are you gonna debit? Cash,
oh.
debit cash,
Then you-
and credit accounts receivable.
Okay, so
Now, credit accounts. See, now fees earned, you've already done that back when you debit accounts receivable, and your credit fees earned. So now your credit accounts receivable, you get the cash, debit cash. You're doing good. You're catching on real quick.
You don't put that under accounts. Correct. You know, right now.
Is this 31 the first one? This is going to be cash on account receivable.
What does it say?
It says fees earned and billed to customers.
It's legal.
They don't really have it.
In cash, so.
Okay, it's account receivable.
Right.
The debit and fees earned.
Again. Yeah.
All right, so this was debit cash and then credit bill and loans.
Credit cash comes out of business's account.
All right.
Business uses account. Business loses cash. When it gains cash.
You got it.
Accounts payable, that's like, you don't have it, I mean, so like, you say like you pay on account, so like, you're not like, cash or like, that's particular cash, but I mean, so you pay for an account, that's expensive, well. On accounts payable. Yeah, since you didn't pay, you just bought it, kind of like you use your credit card, you swipe, you gotta pay it back, you know what I'm saying? So just same thing with accounts receivable, like, they're saying like you receive, like you bill somebody. So let's say like you trade, right? You trade in that, and then you bill them for the amount they get paid. That's accounts receivable still it's coming, it's still you earn it. So it's fees, accounts receivable fees earned. So this one.
Got him? Did you help your neighbor?
Of course.
Okay.
You're gonna get this, you're gonna get this A, this class.
It's there to get. You can get it.
I'm gonna show you what this is later. You go through 2 days.
Oh, no, I'm just.
Oh, that's.
I can just, I can.
Okay, let's look at the correct answers. And you can see here, the author didn't put explanations, but at least he skipped a line. Debit rent expense and credit cash. When I say debit rent expense, do not write down the word debit. Debit means put it here.
Right.
Okay. And credit cash. Then debit advertising expense, credit cash. Debit supplies, credit cash. Now, at the end of the month, we'll count supplies and they will turn into an expense, but not now. Debit equipment and credit accounts payable. Don't debit equipment expense, it's an asset, not an expense. Then debit cash from a customer and credit accounts receivable. And then you add accounts payable. On the 16th, debit accounts payable and credit cash. All right. What did it say about on the 27th? What kind of expense did it say?
Miscellaneous expense.
Well, it said miscellaneous. Okay. So, and credit cash. This one said utility expense. All right. Now, when you get down to the 31st, though, your debit accounts receivable credit fees earned because they didn't pay you cash. Then you got utility expense. Then Jason's, it is Jason paying now drawing and credit cash. Now under accounts receivable, one person wanted to put the person's name. Now remember, accounts receivable is usually debit unless they pay you. You don't put the person's name yet. Later, we will have to put the person's name so we can keep up with who owes us. We may have 100 customers. Right now, we're just putting all accounts receivable in one account. This person pays us. Accounts somewhere up here. Yeah, they pay us here, debit, cash, and credit accounts receivable. And we will have to keep up with our payables and our receivables, companies and customers, but that's to come later. Right now, let's just learn the journal entry. Now, most of you were doing pretty good on these. And some of you got straightened out. You were doing it wrong. So you will learn these by doing them. Okay? Now, if you had bookkeeping, you should know journal entries. Okay? And you should know posting and so forth if you had bookkeeping. But still, we're starting at the beginning. It doesn't matter if you had any background or not. We're starting at the beginning. So, assuming that nobody has bookkeeping or accounting, okay? All right. Now, there's other little exercises in here along the way. And if you read these exercises, you can do all of them you want to, do all of them that you want to, and there are solutions to check them if you want more experience. But the two I want you to do for Tuesday is practicing, all right? The two for Tuesday is 1A, taking you all the way over to the problems, and 2A. Now, 1A, I don't know what's wrong with these solutions. 1A, I'm thinking this is T accounts. I think this is a cash T account, and these solutions are just not coming up or even showing up. That was probably a T, and you're to put those entries directly in the T account. Now, problem 2, okay, here's your T. This is better. These T's are showing up. Cash equipment's not showing up good, but supplies is showing up okay. Prepaid insurance, they're still scrambled. These solutions are coming up funny. So try to do 2 1A and do trial balance. Now you have to use just plain white paper. You can draw T's on plain white paper. And you can draw this little trial balance on plain white paper. Now, when you get to this one, I want you also to do 2A. Now, you can put these entries on plain white paper also. You know what a journal looks like now. I handed you out a sheet. So try to do 1A and 2A for Tuesday and be working on Cengage. And of course, some of you need to read chapter 2. So I got to get out of here in a couple minutes on my way to Detroit tonight. So I've got 3 things up there. I've got a sick sister, I've got a wedding of a nephew, and I've got a family reunion. So I've got 3 things to do this weekend, and I'll see you on Tuesday. You know what?
So you on tour, ain't you?
I reckon.
You have a good weekend.
Okay, thanks.
Corey, maybe later we will do it.
Take a couple of these sheets of paper. That's horrible on illustrating, not exercise and not practice problems. All the way over to the top. Page what? Page.
Yeah.
You'll get it. Right? You got a book on it. Better get it, you're going to get lost. Okay, thank you. Okay.
Other things like that.
Okay.